So I haven't posted the links, but I do have a YouTube channel that I'm recording these lectures. And so outside of class, you can go and take a look at them. If you're, doing your work or you're studying and you're not too sure about what's going on, or you forget something maybe covered and don't remember, you can go out to my YouTube channel. It's Jane the Accountant is the name of it. But I'll also post links in Blackboard so you guys know where to go to do that. So chapter 2, I'll get those up. I posted it onto the online class. I got to post it over to you guys. But chapter 3, I'll get that posted up to you guys too. Okay, which is what we're going to be covered tonight. All right. So chapter 3 is dealing with cost, volume, profit analysis. All right, so our first objective is we're going to explain the features of cost-profit analysis. We're going to determine the break-even point and output level needed to achieve a target operating income. We're going to understand how income taxes affect the CVP analysis. And we're going to explain how managers use CVP analysis to make decisions. We're also going to explain how sensitivity analysis help managers cope with uncertainty. We're going to use CVP analysis to plan variable and fixed costs. Apply the CVP analysis to a company producing multiple products. Apply the CVP analysis in service and not-for-profit organization. And then we're going to distinguish contribution margin from gross margin. Okay? Mm-hmm. So, what is CVP and how is it used? Managers want to know how profits will change as units sold of a product or as the units sold of a product or services changes. So basically what it does is how will my profits go up and down? Because as we go, a lot of times what happens as you produce more? What happens to cost? Like cost per unit and things like that. The more you buy, the less it costs, right? And so that's what CVP does. It helps you determine that. Managers like to use what-if analysis to examine the possible outcomes of different decisions so they can make the best one. So they can take this information and say, okay, if I do this, how much is it going to cost me if I do that? And compare the two. A lot of times this is done when we're looking at two different products. Maybe one type of lens versus another type of lens, and how do we produce the number that we need in regards to which one's more profitable and which one will give us, less costs and more money in our pocket. In chapter 2, we discuss the total revenues, total costs, and income. In this chapter, we'll take a closer look at the relationship among these elements, including selling price, variable costs, and fixed costs. Now, have we talked about the 5 steps?
No.
Okay, so we have 5 steps decision-making process. The first one is to identify the problem and uncertainty. And then, so basically we look at this and say, okay, what is the issue that we have? Now, I believe what happens, there is one that in the book that we've been talking about this whole chapter. I'm not sure exactly which one it is. We'll have to take a look at that here in a second. So we make a decision or we identify the problem. And I think one of the examples in the book that, I don't know if it's this chapter or a future chapter, it talks about one lens versus another lens. Should we make both lenses? Should we discontinue one lens and just focus on the second lens? Or what kind of mix we can do if we want to do both of them? Okay? Then obtain information. That information, when I say obtain information, what I'm talking about, costs. How much can we sell it for? Things like that involving the product itself. Make predictions about the future. So then you take a look at what your history is and what you think the market's going to do in regards to, are you going to be able to sell a lot more or a lot less? So like in my eBay business, I look at the type of jeans I have, and I look and see what are they selling on eBay for, and are they selling? So if I get a pair of jeans from Old Navy, you know what? I'm not going to sell those because they're not selling at all. But if I get a pair of Lucky jeans, then I'm going to sell those. So if I have a choice between a Old Navy pair of jeans and a Lucky pair of jeans, I'm going to take the Lucky pair and sell those. Okay? So it's kind of like that. Making the predictions. I'm saying, okay, I'm predicting Old Navy is not going to do really well, but Lucky is going to do really well. Or you're taking a look in manufacturing. How much do you need to produce? You're making predictions. How much are you going to sell? Which drives how much you produce. And then making the decision by choosing among the alternatives using the cost volume profit analysis. So if we're looking at those two different types of lenses, we take a look at everything we analyze in regards to cost and production volume, and which one is the better choice for us. And we make that decision. And then the fifth one is implement the decision, evaluate the performance, and learn. So you'll learn that in this whole case, anytime you're doing this kind of analysis, once you make a decision, that it doesn't end there. Okay? You constantly have to go back and look at what you've done. Say 6 months later, did your predictions live up to what you thought, or what the actual thing, did it live up to your predictions? And if it did not, then you got to find out why it didn't, or did it exceed your predictions? And maybe you need to make adjustments. Okay, so this is kind of like a cycle we're looking at. You're always looking at it to make sure you're making the best decisions for the company. So, example, I was just putting up something for sale earlier today, a 35 millimeter camera. Now, if I was Canon, producing cameras, do you think I'm going to be producing a 35 millimeter camera right now? No.
No, you filmed it.
Yeah, exactly. Okay. So when the film cameras started to go away, Canon had to be very upfront with the fact to say, hey, we can't produce these anymore, or we need to back off and go more digital. The world is going more digital, so we need to reallocate our resources from producing film cameras to digital cameras. Okay? So it's that cycle. You always have to be looking at what you're doing and where you're going and what is the demand for your product. Because again, you don't want to produce a 35 millimeter camera when no one's buying those things anymore.
Nope.
Okay.
I've got a Nikon F and it's worth about, if I can catch the guy drunk, I'd probably do $100.
All right. Now, some of the assumptions we make when we are doing a CVP analysis. Changes in production are the only cause for cost and revenue changes. Okay? So, changes in production sales volume are the sole cause for cost and revenue changes. Where's the issue with that? Are they the sole cause? We just talked about Canon and the 35 millimeter camera.
Oh yeah, the environment.
Yeah, okay. So that's one of the drawbacks of CVP analysis is the fact that it just focuses on the production and sales volume. Okay. Total cost consists of fixed costs and variable costs. All right. We always say there's nothing else involved. Revenue and costs behave and can be graphed as a linear function. So linear function means a straight line, right? In reality, anybody remember the supply and demand curve? It's not really a straight line, right? But that's something that we assume when we do a CVP analysis. Selling price, variable costs per unit, and fixed costs are all known and constant. Big issue there, right? Because, in the real world, are fixed costs actually fixed costs? No, okay? They're not. Variable costs, we're saying that it's going to cost me, variable cost-wise, $15 per unit. But in reality, it probably is not. Because we have different things like more labor, less labor, things like that. Cost of my material, my direct materials might fluctuate, you know, based on what's going on in the world. You know, oil is a perfect example, and gas. Gas is what fluctuates all the time, right? So we have to say, and when we're doing a CVP analysis, that those pretty well stay stable. But in reality, they don't. So again, that's why we always have to analyze our decisions afterwards. Okay? In many cases, only a single product will be analyzed. If multiple products are studied, their relative sales proportions are known and constant. So basically, when we're doing these type of analysis, we're only looking at one product. Later on, we do multiple products in one of our examples. Basically, what we're doing is looking at one lens versus another lens. But then there, we have to say, okay, our product mix is the same. Or our product, we know our product mix. In reality, we don't know our product mix, do we? You know, we can get a good idea of what it is, but we don't. But in a CVP analysis, we assume that the product mixes are known and constant. They don't change, okay? So those are some of the assumptions that we have to make. And the time value of money or interest is ignored, okay? So those are some of the things. Now, what is the...
So a lot of the assumptions don't meet with reality.
They meet with the reality at the time we do it, okay?
Just a snapshot.
Yeah. You remember, you've got to constantly be looking at it. Because, and you wouldn't be able to do analysis if you didn't make assumptions like things are fixed, things, you know, they're constant and things like that. We wouldn't be able to do analysis if we didn't make those assumptions, okay?
Right.
But again, it goes back to
But
your...
it bends that straight line with your curve.
Yeah. So it goes back into, you know, again, once you make a decision, that's not the end of all it, you know, ends. You always have to go back and analyze and make sure you're still on the right path. Okay? Now, the contribution margin. Manipulation of basic equation yields an extremely important and powerful tool extensively used in cost accounting. So we're going to be using the contribution margin a lot in this class. Now, what is the contribution margin? Anybody? Don't look at them. It is your fixed, it's revenues minus your variable costs, okay? So your contribution margin is your revenues minus your variable costs. That's something you guys got to know because you'll be using that a lot, okay?
Okay.
Now, so I could have, say, $1 million and then $500,000 in variable costs. So my contribution margin would be $500,000, right? Now, how do I get the contribution margin per unit?
Divided by the number of units.
Exactly, okay? And that's really the number that you really need to know. All right, so say I have 5,000 units, okay, $1 million in revenues, and 500,000, I'm just making this really easy, in variable costs, okay? So that means that my contribution margin is 500,000, right? I take the million minus the 500,
Yes.
and I get 500,000.
Yes.
Then I divide it by the number of units, which is 5,000.
Yeah.
And so my contribution margin per unit is 100.
Oh, yeah, yeah.
Okay. Does everybody see how we got that? So that is something that you need to know, understand how to do because we'll be doing that a lot in this class. Okay? Any questions on that? Now, you can also calculate the contribution margin, which is equal to the contribution margin per unit multiplied by the number of units. So if you have the contribution margin per unit, and then you know the number of units, that will give you the total number of contribution margin for the total, money-wise. And in some of the homework assignments, that's what you do, is you determine the contribution margin on their original amounts, and then you say, okay, what if? And then you take the contribution margin per unit and multiply it by the new number of units to get the new contribution margin, okay? The percentage, how do I do that? Which is the contribution margin per unit divided by the unit selling price. So, say if my selling price is $250, well, let's go $300, okay? So then my contribution margin percent would be what? The margin divided by 300, which is 33%, right?
Okay.
So what does that tell me?
That's a comparison.
Think about it. What am I dealing with? What is the contribution margin?
33% of your sales is your profit.
33 is not my profit.
Of your revenue.
33% of my revenues is not my profit, but my cost, my variable cost.
Okay, that's
Okay? So 33% would be my variable cost.
Right.
Okay? All right. So, this is a very important equation that you need to know, which you should know because it's kind of what we did in financial accounting, right? A little bit, right? So we have revenues, variable costs, fixed costs, and operating income. So what do you do? And this is a good thing, you know, it's algebra. You'll be doing a lot of algebra stuff on here. But selling price times quantity of units sold minus, then for variable costs, we take the unit variable cost times the quantity units sold. That's those two parts of it. And then we have the fixed costs. And so, say if you know the units sold, say we sold 100 units, or we know the selling price and we know the variable cost price, say selling price is 5 and then variable cost is 2 minus 1,000 equals 5,000. So you can take that, say my selling price was $5, my variable cost is $3 per unit. This is what you would do. The X would represent what? The number of units. And you need to know how to do that for some of the homework assignments. Okay? So if you don't know the unit cost or you don't know the units, that's your X. And you take the 5X, you take the selling price times the number of units, then you take the variable cost times the number of units, then you have your fixed cost, and then that's your profit. Okay? So remember, selling price times quantity of units equals revenue. The variable units, unit variable cost times quantity of units sold is variable cost. The revenue minus variable cost equals your contribution. Contribution margin minus fixed cost equals operating income. It's really good to keep those going in your head at all times because sometimes they might give you, the contribution margin. And you got to figure out, you have to back into some numbers sometimes. Okay? Now, what is the break-even point? When I say break-even, what do you guys think of?
You don't make anything, but you don't lose anything.
Yeah, exactly. Okay? So in layman's terms, it's basically Whatever you bring in covers your costs.
Yeah, that's true.
Okay? So I have to do so much work, I have to sell so many units, and I have fixed costs because I have to pay those no matter what. So in order to cover those costs, what do I have to do? I have to sell so many units. So how do I figure that? We have, basically the formula would be sales minus the variable cost minus the fixed cost equals 0. Okay? So break even units. So we could take the fixed cost, if I know the fixed costs, and I know my contribution margin per unit, because what is contribution margin? It's basically what's left over after my variable cost, right? Okay? So that could, takes care of my contribution really goes towards the fixed cost. So I take the fixed cost divided by the contribution margin, and that will give me my break-even units. So say if I have fixed cost of 1,000, and then I have contribution margin of 4, okay? So if fixed cost even 1,000, and my contribution margin equals 4, my break even, I would take the 1,000 divided by 4. That means I would have to do what? 250 units before I made a penny. Anything below 250, that means I lost money, right?
Yeah.
Any units after 250 means, guess what? I'm starting to make money. 251, I start to make some money. Okay? Break even in revenues, same thing. I take the fixed cost and divide it by the contribution margin percentage. Okay? So I take what? The 100 divided by 300, the 33. So I would take that fixed cost divided by 33%. The other way to do this is half. So if my break even in units is 250, and then let's say my fixed cost, so that's break even, my sales price, say that is $10. Another way to say is 250 times 10 equals 2,500. So you can do it a lot of different ways. So if I know the sales price per unit, and I know the if I know the break even in units, I can take the units times the sales price, and that will give me my break even in revenues. Okay? So there are so many different ways to figure this out. All right? Any questions on that so far? Yes, no, maybe? All right. I need a little clicker that releases these things.
Would you have one?
I don't know how to do it. Well, yeah, I don't think it does. All right, so break even, extended profit planning. The break-even point formula can be modified to become a profit planning tool by adding the target operating income to fixed costs in the numerator. So basically what that would mean is I have fixed costs of 1,000, right? And say I want a profit of $1,000. I have to cover my fixed costs and then get to $1,000, right?
Yep.
So I would add those two numbers together and divide it by the contribution margin, and that will tell me the units I have to sell. So in our example here, if I want $1,000 of target operating income, here I would take the 1,000 of fixed costs plus the 1,000 of operating income and divide it by my contribution margin of 4, right? And so now I have 2,000. Yeah, and so that means I need to sell 500 units to get an operating income of $1,000. Okay? So I do know one of the example or one of the homework assignments, it asked you for a break even And then it asks you if you want a profit of, I think it's 159,000. Okay? So you take your fixed cost plus your profit, what you want, and divide it by the contribution margin to get the number of units. All right, any questions? All right, so let's look at this example here. Now, I always like to kind of summarize, like if it's a word problem or things like that, I like to pull out the information and write it out, separately, away from everything else. So I just have bullet points. So I don't have the words messing me up a little bit. All right, so it says Emma has fixed cost of 2,000 and a contribution margin percentage of 40%. So we have 2,000 fixed cost and contribution margin percent equals 40%. If Emma wants to make a profit of 2,000, so profit of 2,000 and profit of 3,000. Okay. And then it talks about what's the formula. We have fixed cost. We have plus the target income. So the profit is the target income, right? Divided by the contribution margin percent. Okay? All right. So how would I set up this equation? Yeah, because we have fixed costs in the profit. So let's look at the first one. So I'm going to write it here so the video can show it. We have 2,000. That's the fixed cost, plus the $2,000 for the profit that we want. Divide by 0.4, because we got to convert the percentage into a decimal, right? So then what? We got 4,000 divided by 0.4. So what do I get?
10,000.
10,000.
So if you got to crank out 10 grand to get 2.
Yes.
Okay.
Okay. So now if you do the other one, 2 plus the 3 divided by 0.4, I get 5,000 divided by 0.4. What do I get there? $12,050. $500. Okay? Now that's just the revenues. Right?
Can you back up just for a second?
Where?
Back up to one. You get,
Get it?
it's down.
Okay. So here's the detail to that, what we just did. Oh, where's my eraser? I lose things all the time. All right, nice and pretty now. We have the operating income of 2,000, revenues, and we want fixed costs of 2,000. Add those together, 2,000 plus 2,000 gives us 4,000 divided by 0.1. I get a $10,000 in revenues. The operating income of 3,000, we take the 2 plus the 3, divide by 0.4. I have to have revenues of 12,500 to get the, what I want. Now, graphically, here's what we have. Now, this line is what? This is my total revenue line. So it says anything that over here, the bottom line here, and goes up, that's my total revenues. So it's saying 2,000, if I sold 10, I would make $2,000. If I sold 20, that's going to be about $4,000. If I sold 30, that's going to be about $6,000 and so forth, okay? Now, we also put over that graph the cost graph. So we have, if I have 10,000 units, I'm going to be probably about 3,000 or 10 units. If I have 20 units, I'm going a little bit higher than about 4,000. Okay? 3,000, what happens here? The cost graph or cost line goes below the revenue line. The point where they intersect, which is 25 units, is what we call our break-even point. So anything to the left of the break-even point, that means I'm going to have a loss. Anything to the right, so our goal is to make this cost line lower than the revenue line. So, and as they get further apart, the bigger the profit. Now, how did they get the 25, my break even with 25? They're saying my variable costs are 120 and the selling price is 200. So we determined what? 10,000 divided by 80. I'm not sure. I have to look at that one. All right. So the goal is to be the right of the break-even point, right? Yeah. Now, what do we not take in consideration when we're talking about that? Taxes, right? All right. So we always need to take into consideration. Some of your assignments will be based off of just regular, variable costs, fixed costs, and so forth, okay? But there's a couple of assignments that is going to be also including taxes. So in reality, what happens here? Yeah, okay? So we have the revenues minus variable cost minus fixed cost equals operating income, and then minus taxes equals net income. Yes, okay? So how do we figure into our taxes here? You take the net income, which is our operating income. We take our operating income times 1 minus the tax rate. So basically what we're saying is we take our operating income times what's left over, the percentage left over. So if our tax rate is 20%, what's left over? 80, okay? So I take 1 minus the tax rate, or what's left over. So, and a lot of these questions are going to be based off of, I believe, 40%. So what you're going to do is take your operating income times 60%. What's left over? Okay. So net income can also be converted into operating income using a CVP equation. And again, it's just algebra when we're looking at this. So what do I do to this equation here? I divide both sides by the 1 minus the tax rate, and I solve for operating income. So operating income is what? Net income divided by 1 minus the tax rate. Okay? CVP equation will continue to use operating income. We'll use this conversion formula to obtain the operating income value when provided with net income.
I think go along with the other part of the exam of 1 minus the tax rate.
It's what's left over. Your net income is what's left over after taxes, okay? So if you're paying 40% of taxes, what's left over?
Then you got 60%.
That gets in your pocket, right? That's what, kind of think of it like this way. If you have an item that's $100 and they put a 25% tax or, discount on it, what do you actually pay for that item? $75, right? Okay, so that's what we're trying. We're saying what after we have to take out whatever. Okay?
And then after that,
But you assume that in the homework assignments that we deal with, you're assuming that unless they give you the tax rate, you don't worry about the tax rate. Okay?
thank you.
So they have a wonderful little chart here that really helps you in regards to determining what you would do given the situation. So in this case, we have 3 groups of fixed costs. We have fixed costs of $2,000, we have fixed costs of $2,400, and we have fixed costs of $2,800. My variable cost per unit is $100, $120, and $150 for each one. And so based on that information, we're going to determine what are my break-even points and what is my the number of units I have to get to a certain level here. Now, how do I figure this out? What's my contribution margin per unit? It also tells me that my number of units required to be sold at, how much do I have to sell them at? $200. Okay? So I'm selling these units at $200 a piece. And so the first one, I have $100 in variable cost, right? So the first thing you have to do is determine your contribution margin. Okay? So if I take the 200, that's my selling price, and I subtract the variable cost, and the first one is 100, right?
Right.
So that means that 100 is going towards fixed costs. Does everybody see that? So the first line, what does it tell me? My fixed cost of 2,000. So if I divide that by 100, that means what? I need 20 to break even. Does everybody see how I did that? Okay.
Yeah.
And then you do the same thing here. Here on the $120 in variable cost, that means only $80 are going towards my fixed cost. Now, here's the key. You have to forget about normal rounding rules in some of these because you can't sell a partial item. You can't have a partial person, right? So you always have to round up. So if it says, okay, what's 2,000 divided by 80? Anybody?
2.5, something else.
If I take 2,000 divided by 80,
We got 200 divided by 8, which is 16 and 2.5.
4,
2.5.
50 divided by 2, that's 25, right? Okay, so that's not a good unit there. But if that was $81, if the contribution margin was $81,
Yeah.
okay? And I got 24.555 or 24.333 or whatever I get. I have to round up. Okay, that's the key there. You always have to round up. So if your number of units is a percentage or a decimal, you gotta round up to the next one. Because if your answer was 24.5 or 24.3 units, you sold 24, you're still not making a break even, right? You're not breaking even. But if you sell 25, you're a little over breaking even. You make a little profit on that. Okay? All right, so always round up.
So the rounding up occurs both in the calculation of break-even form and the calculation
Well, the number of units.
of, yes,
It's always the number of units. Because
Yes.
you can't, think of this, you can't be a part person.
yes.
You can't only have a
Yeah,
partial
you
person.
can't build part of the TV.
When I sell a pair of jeans, I can't sell just one leg of the jeans, right? Because someone won't be happy. Okay? So you always have to round up to the next unit. All right? So then again, 250, my contribution margin is $50. I divide 2,000 by 50 and I get 40 as my break even. Okay? So the higher the variable cost, what happens to the number of units that have to break even? It goes up, right? So that basically what it means is if your variable costs are going up, that means the amount that's going towards your fixed cost is going down. And that's what the difference is covering is the fixed cost. So it takes me more to cover the fixed cost. Now, to get this 32, how did they do that? So they took the 2,000 plus the 1,200 because that's how much I want to have as my profit. So that's 32, and then I take the 32 divided by the contribution margin of the first one would be 100. So 3,200 divided by 100 is 32 units, and so forth. And so if you use Excel, you can plug this in into formulas to quickly calculate this for you. And someone would do this to really decide, okay, I have fixed costs. What you would do in this case, say, this could be the difference between the different type of advertising. Basic advertising, medium advertising, and the big one here. Or it could be like, I think the example is dealing with like a trade booth at a trade show.
Yes.
And the basic, and then the slightly bigger booth, and then the biggest booth. Okay? And how they would do it, they would say, okay, based on my variable costs here, how many units do I need to sell if I take each one? Okay? And I would say, okay, I want to make $2,000. If I get the smallest booth and my variable costs are 100, I need to sell 40 units just to make $2,000. Okay? And so if you're, in that kind of field, then that's what you would do to decide whether you take the bigger booth or what have you. Does everybody understand what this chart does? Yes, no, maybe? Okay. We also have to have a sensitivity analysis. CVP provides structure to answer a variety what-ifs scenarios. And that's really what that chart did. What did it do? It said, what if my fixed costs are at certain levels? What if my variable cost was at certain levels? And what do I have to do to get to where I want to be? Break even, 1,000, 1,500, 2,000 profit. So what if, the sell price changes? You could also do it based on changing your sales price. We didn't do that. We did a straight 200 on that example, right? So volume changes. We did that. Volume changes. Cost structure changes. Variable cost per unit changes. Fixed cost. That's really what that chart concentrated on, was what would happen if my variable cost went up, and then what would happen if my fixed cost went up. As an example, if a company determines that an ad campaign costing $15,000 is expected to increase sales 25%, should they proceed? The question cannot properly be answered without doing this type of analysis. You have to say, okay, what does it mean? What is my, costs now based on no advertising? And then what is it based on advertising? And compare the two and see, does it really make sense? So for example, the CPA firm I work for, we were the Dave Ramsey ELP for years, lots of years. And we recently decided not to do that.
I'm sorry, I didn't say explain.
Dave Ramsey is a guy on the radio that teaches people how to handle their money, get out of debt, live a debt-free life, build wealth. He has a program.
Whatever the name is,
That you're thinking Susie Orman.
yeah.
Yeah, same type of person.
Okay.
They have different philosophies.
Yeah.
Okay. But he has a program that's called the Endorsed Local Provider Program.
Yeah.
And so basically, if you wanted a tax person, you would go on his website, put in your information, where you live, and he would send you the name of our firm, okay, that we were endorsed by him. Basically, what happened was more people were becoming ELPs, and they gave that endorsement to more people. And so, yes, and so, but they raised our cost per lead. And so we had to do an analysis based on that information. Is the cost that they charge us for that privilege of being their endorsed local provider, would it make sense for us? Does it bring enough money in for us? Because our leads were cut drastically when they added more people. And so we basically did analysis and turned out, no, it didn't. It wasn't cost effective for us. Yeah, we were below the break-even point, so we left them. And then we're doing one on the advertising we do. We do advertising for on one of the stations. They're really down south in southern Indianapolis, in Greenfield, Greenwood area. And we really were looking at that one because we're like, do we get enough leads from that, ad? Because it's expensive, and we did analysis, and surprisingly, we do get enough business that it is very profitable for us. So we continue to do that. So it really is, that's what you use it for. This type of thing is does this cost make sense for you? And, do I want to keep on doing this, or do I want to do something different? Okay? Does everybody get a good understanding of that? Yes, no, maybe?
Yeah.
Okay. All right. So this is really a good place to take a break right now. So let's go ahead and take a break. And then when we come back, we're going to be talking about the margin of safety.
Okay.
Okay.
Where are you in the book right